It's a big day for fans of monetary policy, or a big week, I should say. Both the Bank of Canada and the US Fed set to announce their latest interest rate decisions on Wednesday. The market thinks that in Canada, we are going to get another reduction of a 1/4 percentage point. A lot of analysts and economists think the US might hold pat until the spring. We're joined by Bhawana Chhabra, Senior Market Strategist at Rosenberg Research. Thank you very much indeed for joining us.
Thank you for having me, Andrew.
Just to take a quick look at the Bank of Canada, you think that they will cut again?
Yes.
There's a decent chance they will?
Yes, we think they'll cut a 1/4 percentage point this time because inflation drivers are favorable and bank is moving towards the neutral range. So with this 1/4 percentage point cut, we would be on the upper end of the neutral range, which will bring us closer to 3.25%. And then after that, markets are pricing in about 2.5 cuts for the whole year. So whether it'll settle at 2 or 3 would depend on how the trade war plays out and how the other data comes out. So that's our base case that we're working with.
So, sorry, what is the market, how much of a reduction for the whole year is the market pricing in?
Market is pricing in somewhere around 65 basis points, which is 2.5 cuts, basically.
Right, so not that much more in the way of reductions, but substantial enough,
Substantial enough. And we are in the camp that there would be potential to go on the lower end of the neutral range or more because if Trump launches the tariff war on Canada, we'll have to cut a lot deeper than what markets are currently pricing in.
But you think that the Fed's appetite for rate cuts is cooling and we're going to get a shallower process of rate cuts in America?
So this is what markets are pricing in right now. Fed dot plots indicated 2 rate cuts for the year. Markets were till yesterday at 1.5. Today, markets are in line with what Fed dot plots are telling. And that's primarily because macroeconomic data has been good. Corporate America has been doing well. There's a K-shaped consumer, which is where high-end consumer is doing well. So the economy seems to be chugging along on the face of it. So that's what markets are pricing in. But there is always a potential for surprises. And it could go deeper than that should there be a negative economic shock or any other news which triggers a negative reaction from the markets.
But do you think it's likely the Fed will just stand pat on Wednesday when it comes to interest rates?
Yes, that's our base case.
Now, President Trump just had this face-off with Colombia. They wouldn't take deportees, and he threatened tariffs. Now, apparently that's been resolved, at least partially. But you say it demonstrates that he's willing to use tariffs as a weapon in all kinds of scenarios.
Quite agree to your statement. It's a negotiation tool. If you see, it's a tool in his arsenal. You don't agree to my demands, I'll cut off business with you. So I think that's what all their trading partners are looking at. He's been very clear, he has America First policy. So till the time he gets his way, he'll threaten using tariffs as a tool. And that's what he did in his first term as well, if we see. So we believe this will be around the corner. So most of their trading partners have to be tactful, like how Colombia went about finally negotiating a deal with President Trump. So we'll have, like most of the trading partners will have to do that and manage the tariff threat there.
Yeah, I suppose in politics, optics is always paramount. And if it looks like Trump's getting a win, they can placate him.
Yes. It wouldn't hurt, right? See, one thing that's important to understand is tariffs impact the price levels, but beyond that, inflationary impact is questionable. And no president would want that the inflation comes back into the picture. So he'll use it as a negotiation tactic, get his way, and make sure the economy is chugging along. That's our base case scenario. But given how volatile things can be, like we did see 25% announcement on Colombia exports, so that cannot be ruled out for other trading partners, but we believe there would be negotiations ensuing and it won't be as blanket as tariffs as we see as a base case scenario. But if they do come, they'll definitely have an impact on BoC's decision.
It's interesting, contrasting this Trump administration with the previous one, the economy is not as strong, or certainly the debt picture is not nearly as promising as it was the last time.
Yes, no, I agree. The fiscal deficit is about double the number we had in Trump 1.0. So definitely economy is not that strong. We have, in terms of valuation, stock market is at much higher levels. We are at more than 21, around 22 right now on on the S&P 500 on forward PE. It was around 18 times during Trump 1.0. So the headway, the runway was very different that time than now. And then the majority in Congress is also a question. So overall, it's a very, very different scenario than what it was during the first term.
Right. And so the chances of a third year in a row of blockbuster returns from the S&P 500 are diminished in that sense.
Yes. When we look at valuations, yes. So that's why our investment strategy is more focused on earnings momentum. We believe that you cannot chase price momentum right now because valuations are so high. If markets are pricing in a shallower Fed rate cut cycle, so that means overall valuation premiums are going to be squeezed in. So you need to focus on where earning fundamentals are. So there are sectors which offer good fundamental strength, like communication services, financials. And right now, healthcare looks like a great candidate. So overall, we believe that you should side with sectors with a stronger earnings momentum. It could be revisions, growth outlook, instead of just chasing the price momentum at any valuation whatsoever.
And just very, very quickly, you be wary of rate-sensitive sectors such as real estate because the pace of rate reductions may be slow.
But when we released our last report, we did say that real estate will see challenges because yields were going up at that time. We believe that there is a reversal that has happened with the whole deep thing that has happened. So we are considering bringing it back to neutral from underweight earlier because we did mention that it was a very, very tactical call we took. The moment we see reversal in yields, we would be looking back at backing real estate sector again.
Thank you very much indeed.
Yeah.